Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meisinger, your host here at the ISE, and today I'm proud that we have Jack Crooks with us. Jack's going to be talking about dollar-yen and the carry trade, and like Jack we were just talking for a second prior to coming on, carry trade doesn't have to necessarily be the yen, although Jack's going to talk about that. Jack is the founder of Black Swan Capital, and if you're interested, I'd urge or highly recommend that all of you sign up, go to Jack's website, Black Swan, and go and sign up for the currency currents, and we'll give you all that information at the end. It's a free newsletter. You can get that every day, and you can sign up, anytime you'd like. But I'd highly recommend that you sign up. It's very, very interesting, and you get it every morning. And if you're interested in further sort of advice, Jack has a paid service that you can check out once you sign up for the free one. So, Jack, again, I want to say thanks for jumping aboard here at the ISE. Welcome back, and really can't wait for the currency carry trade presentation. So why don't you take it away?
Thanks, Steve. I appreciate it, and thank you to you and the ISE for allowing me to share these ideas. Hopefully, it's something we can all take away. These things are good for me because it makes me kind of focus my own thoughts as to what makes sense here and what doesn't. In this presentation today, it is titled dollar versus yen carry trade. But what I wanted to try and do in the first part of it was really just show you how you as an investor can evaluate a carry trade setup. Really, what is a carry trade? What are the characteristics of a carry trade? What are the risks of a carry trade? What needs to fall in place for a carry trade to make sense? We've heard this term carry trade many times, and it's thrown out there in the press as just kind of a one-off. But it's not always the case, as Steve just said. It doesn't have to be the yen, and in fact, why we had the yen carry trade going on, and I'll show you a chart on this going on in Japan. Obviously, during the big move in the cycle, we also had another significant carry trade taking place in Europe, borrowing the Swiss franc at the same time because it was the low interest rate currency in Europe, and so we'll get to that. So just wanted to really frame this from more of a theoretical standpoint so you can evaluate carry trades, excuse me, I have trouble with that word, in your own right, and not just look at it as a one-off opportunity and also an evaluation of the risk. So our disclaimer. Here's the agenda, really, just define what is a carry trade, why does it happen? What are the key assumptions that really make up a carry trade opportunity? What are the opportunities and risk? And Steve's going to talk about some examples using the IFE FX options, as Steve had just mentioned briefly. In terms of our view, we tend to take a global macro view, especially for the options area. Our holding time frame can range from a few weeks to several months, and we think the options are just perfect for that. Just a perfect product for that, because if you get it right, using the FX option, which allows you to enter with limited risk, and Steve will talk about that, you can really get a payoff as opposed to doing something else with an ETF. That's fine. Or doing something even in a multi-currency deposit account or something. That's fine too, with a very long-term objective. But all of us like to be paid if we get it right, and the FX option product can pay us if we get it right. And it's a good product to use for these various carry trade opportunities. Okay, what is this thing called a carry trade? It's really quite simple. You borrow the low-cost currency. Interest rates are the driver, and I'll get to that in a second. You convert the borrowed currency into a currency of your choice, whatever that may be. And you reinvest those proceeds into higher-yielding currencies. An example there would be, and what the big trade that was going on was borrowing in Japan at 0.5, 0.75 interest rates and reinvesting those proceeds into a currency like New Zealand dollar or Australian dollar at the time, in the midst of that big boom we had, paying 6.5%, 7.5%. So right away your yield differential is huge, and that's really the primary driver. But in terms of the carry trade currency, it not only funds investments into other currencies, it also funds investments into stocks, bonds, commodities, derivatives, real estate, etc. It really tends to a carry trade currency really tends to feed a lot of other asset classes, in general, somewhat risky asset classes, because you're borrowing and you're exposed. But in the cycle we've just seen, 2001 to 2007, before the credit crunch, which changed the game on all of this, the carry trades were used to invest in all these things. And as I said earlier, we saw a Swiss franc carry trade develop in Europe because Swiss franc was very low in Europe, and we saw a lot of the Eastern Central European countries use the Swiss franc. They borrowed the Swiss franc, turned it into their own currency, and then reinvested in real estate primarily, and then just their own houses. On the institutional side, we saw a lot of Eastern European companies, borrowing Swiss to develop all kinds of developments throughout those countries, and it's come back to bite them. And we've seen the hedge funds really use this carry trade in a very big way, and not only just borrow, but then the hedge funds turn around and leverage this stuff up in a very big way. And they buy commodities, and they reinvest in derivatives, other risky asset classes in emerging markets, all types of things. And just imagine what a hero you were. Say you started a hedge fund in, say, 2004, 2005, and you could borrow Japanese yen at 0.5% and turn around and leverage that up 5, 10, 20 times and reinvest into a currency like the Australian dollar that was continuing to appreciate against the Japanese yen and against the U.S. dollar, and pull down a yield of 6.5%, and also get the appreciation of the currency. You were a hero. You were a big-time hero. And the dirty little secret is that hedge funds, despite the fact that there's some very smart people that run hedge funds, there's only so many good ideas in the world. So what you see is the hedge funds pouring into the same idea, and they like the carry trade ideas because they see it as a layup, or at least they used to see it as a layup and didn't understand the risk. With the change in the environment, the credit crunch, a lot of those hedge funds have gone belly up and now understand the risk of carry trade, and we'll talk about that too. So, 3 simple steps. You borrow a low-cost currency. You convert that into a currency of your choice and then reinvest those proceeds really into a higher-yielding area, whether it's a higher-yielding currency, higher-yielding bond, or the potential for a higher capital gain relative to your cost in commodities, derivatives, and real estate. That's it. That is what a carry trade is.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.